Hey everybody, it's Matt Bowles. Welcome to the webinar. We got a really special event for you tonight. Let's just start off by doing a little housekeeping here. We are going to go for about 1 hour tonight. We've got a live chat box. That should be on the right-hand side of your screen. Let's just go ahead and check that out, make sure it's working. Go ahead and type into that chat box. Let me know where you're tuning in from tonight. And let me know if this is your first Maverick Investor Group event ever, or if you have been on one of our webinars before. Go ahead and type that into the chat box, and I will be able to see those come through. And this is how you're going to be able to communicate with us throughout the webinar. We are going to take your live questions at the end of the webinar, because we're probably going to cover a lot of them during the course of this webinar, but we definitely want to take your individual questions live at the end. So go ahead and type into the chat box. Let me know where you're tuning in from tonight, and let me know if this is your first Maverick event so that we can welcome you here properly. All right, we got John from Minnesota. All right, we got California's in the house. Dallas, Texas is in the house. Okay, some first timers, some second timers. All right, so welcome, everybody. Welcome to everybody for the first time, and welcome back, of course, to all of our returning folks. Sarah from Rockford, what's up? Good to have you here. A lot of folks that are building their portfolios with Maverick Investor Group of cash flowing rental properties on here tonight to learn how to increase and maximize and optimize their tax advantages on the real estate that they've already bought. And so people that are looking to plan out their tax strategy, I'm sure, as they begin their real estate investing journey. So awesome. John, first time from Las Vegas, welcome. Saul, welcome. Amazing. Chicago's in the house. San Francisco's in the house. Awesome. Good to have everybody here. A super warm welcome. If this is your first time attending a Maverick event, I am Matt Bowles. I'm the co-founder of Maverick Investor Group. We started our company back in 2007, and we have been, since that time, featured in a lot of the different real estate investing press. You may have heard of our company. And basically what we do is we help you to buy cash flowing rental properties in the most investor advantaged U.S. markets, regardless of where you live. And those markets change over time. And over the last 15 years, we've helped our clients buy in different U.S. real estate markets, always turnkey rental properties. So either brand new or fully renovated properties, tenants already in place. So you're closing on performing, cash flowing, stabilized properties with professional property management locally in place, so you can buy in the best real estate markets regardless of where you live. And a lot of our clients have been buying with us for over a decade. They've been building a portfolio of cash flowing rental properties over time and diversifying across markets. And that's what we do, and that's what we're here to do. The other thing that we like to do, which brings us to our event tonight, is we like to help to support you and educate you on the different aspects of real estate investing and how you can optimize your real estate investing and the returns and the money that you make and the money that you keep. Okay. And so for that, we have tonight a very special educational webinar. I am super excited to present to you Diane Kennedy. If anybody does not know who Diane Kennedy is, she is a multiple-time New York Times best-selling author. I first came across her work over 15 years ago, actually, before we started Maverick Investor Group. She was already a New York Times best-selling author and CPA at that time, writing about real estate loopholes and all of this kind of stuff and all the tax advantages that go along with real estate. And then once I started reading her books, I started buying her other books and her other books. And I was reading all her books. And then eventually I said, I've got to
I think Matt's screen might have frozen on us. We're both calling in from different areas. So I'm going to go ahead and jump into this. I'm assuming that I've still got a good connection.
Accounting for my company and a lot of the clients that are with us as well. And the reason is, of course, because she is one of the most dynamic, impressive experts in this space in the entire country. And so she has offered to come here tonight and do a 2022 update for all of you on how to optimize your tax benefits, how to pay less taxes on the rental properties that you own. Thank you for that. Diane, welcome to the webinar.
Thank you, Matt. You know, it is amazing to think about that we've been doing these kind of things for 15 years. We started out live, and now we're in the webinar space that we get to do this. Matt talked a little bit about the fact that I've been a New York Times bestseller, which is on tax books, and have been featured on a couple of programs. But I want to talk about, just for a second, that when you're looking for an advisor, whether it's a legal advisor, a financial advisor, a tax advisor, a couple of things to look for besides making sure people understand the space. You know, they got the education and experience you want, but also a point of view. And along with that, I just want to tell a little story about a new client that came to me. And he was somebody who was just been getting going in real estate. And he wanted to know what I thought about real estate. And by the way, my husband and I have been investing in real estate. I mean, we met at a real estate conference. So we have we were investing in real estate before we met each other. And we've been together a long time. So we've been doing this for a long time. But the new client said that he had looked at a property and then he took all the numbers to his accountant to look at it. And he asked him, is this a good deal? And the CPA said, no, it's a horrible deal. Don't do it. It's like, okay. And then he went and got another one and brought it to him and said, well, what do you think about this one? And the guy said, nope, don't buy it. Don't buy it. And so he's like, okay, I'm going to try one more time. Went in there with the third one. And the accountant said the same thing. It's not a good deal. And he said, well, what would make a good deal? And his accountant said, none of them. I don't invest in real estate. I don't even own my own house. And so that leads to a point that sometimes when you're looking for advisors on your team, it's not just education and experience, but also point of view. Is this somebody who invests in what you want to invest in? Do they have other clients who do that? Because that helps you get the experience from your advisor that goes way beyond what the books might say or what the tax laws might say. But that just kind of leads up to this. When I talk about this, my husband and I, we still invest. We still are looking for deals, and we've been investing for a lot of years. Can I run the slides now, Matt?
Yep.
Okay. All righty. All right. So with that, I'm just going to jump into why I like real estate. And I know that Matt talks about at least 3 of these things. I've got a 4th one I want to mention too. Well, first of all, it's one of the few assets that give you cash flow. You don't have to sell the asset to get that. You know, people are talking about with inflation, maybe we should be buying precious metals. And I'm not saying you shouldn't, but if you want cash flow, you're going to have to sell the precious metal unless you get, some kind of a scheme that maybe gives you investments in that with some capital gains associated with it. Real estate is easy. It's geared to give you cash flow. Additionally, there's appreciation. That's why so many people look for real estate as an inflation hedge, because not only does your cash flow improve with inflation, but so does the appreciation. And then, third, tax breaks. I don't know anything that gives you the kind of tax breaks that you can give with real estate. We're going to talk about that today. And then the one that right now is attracting a lot of my clients is the fact that it's the one thing that you can invest in that gives you cash flow and appreciation and tax breaks, and you can do it passively. You don't need to be the one doing the work. I mean, my clients that have got business, they know how to go work and make money, but real estate works for you. You don't have to work for it. And I know that that's something that Maverick Investor Group is so good at, is you don't have to be a landlord. You're not the guy who's fixing the toilet at 2 a.m. Instead, you're buying this like a big pension plan does. They're buying based on return. And that's the kind of things you need to understand, is the numbers that go into that. And that's the beauty of being able to invest with investments, not just buying a house, but buying an investment. And that's the beauty of why so many of my clients are moving to real estate as where they put their money. Okay, I need to just quickly go over this thing. I always call it the things our lawyers make us say. I'm going to be talking about different tax strategies here, and they may work for you, they may not. There's going to be usually little asterisks there that go along with that. And the biggest one is please check with your own your tax advisor, your legal advisor, before you put anything in place, because these things need to be customized for what you've got, and you might have some nuances that in a webinar like this we won't necessarily cover in depth. All right, so with that, I'm going to just jump into some basic real estate investment strategies that I like with my clients to talk about. One of these is the 5 free and clear house property. It's a strategy, and I'll talk about what that is. The 10 loans, the capital gains exclusion, the idea of critical mass, and then how you can do a rent to own. That's another type of way to create cash flow. So with that, let me just jump into this a little bit further. Okay, I'm going to talk about free and clear. What does free and clear mean? You don't own any debt on that. So sometimes what I have with my clients, what they want to do is buy property that right in the beginning, they're going to need debt on those in order to buy those. You know, you need 20% down usually on an investment property. But with the fact that you've got a tenant helping you pay down your debt, you know, you don't have to make the mortgage payment. Basically, your tenant's doing it for you, and you've got appreciation building it. A lot of times, all you need to do is buy some property, hold it, and then over a period of time, usually within 10 years, you can sell some of those properties off, use those funds to then pay off houses. And the idea is that with certain, I'm going to go through the detail on that, but you can actually end up with 5 houses that are free and clear without having to do anything other than buying the good properties that have got cash flow. Cash flow, when we're talking about that, I'm talking about cash flow that flows to you. I have to add that because I had a couple that came in to see me once, very highly educated people, both were medical doctors, and they were trying to figure out what their return was on the properties, and the numbers didn't work. And they said, well, we can't figure out what our cash flow is. And the problem was that they were paying every month. They had bought some properties that they fell in love with in a very expensive place, and the rents didn't even make the mortgage payments, so they had to pay every month to keep them. And they couldn't figure out why the cash flow wasn't working. It's because they weren't investments. So when I say cash flow, it's cash flow that comes to you, not the cash that's going out. Passive appreciation refers to the fact that property will go up over time, just like that idea that a rising tide raises all boats. There's also active appreciation, which those are the kind of properties that you might buy that are fix and flips or fix and holds, that you're doing something to make them worth more. Passive appreciation is the part where you're working as an investor and it's just going up over time. And the 10 loan program, what I'm talking about there is the government has federally backed loans, and provided that your credit rating is good and that property makes sense as an investment, you can get up to 10 loans that are federally backed. So that's the Fannie Mae, the Ginnie Mae, the Freddie Mac loans. Those are the best kind of loans pretty much that you can get for real estate. I'm not going to say that maybe you've got a better deal with the bank, but for the average person, these are the loans that you're going to want, and you can get up to 10 of those. That includes the house that you live in, and if you have a vacation home, that would take another one off the market. That would mean if you had both of those, you could only get 8 other properties. You can get a single family home, you can get a duplex, a 3-family home, and a 4-family home. More than that, you're looking at different kinds of loans. But for a lot of my clients, the first strategy when they start investing is to get those 10 loan property. Use up those 10 loans, that you're going to get a lower interest rate, and you've got a 30-year fixed loan. It's not something that's going to adjust every 3 years, and you don't have balloon payments on those. That is a great, good kind of loans. Think about getting those 10 loans. And then finally, the cash on cash return. We talk about ROI. I know Matt loves the ROI return calculation. I also like the cash on cash return, which is where we look at how much cash you put into the property and then look at how much cash you're getting back from it. The reason I like to look at that is ROI is a great number to watch as well, but with cash on cash return, it gives you a good sense of how well your investment's working for you. Sometimes I'll have clients that will take a small loan. They'll make a big equity payment, maybe 50% down, in order to try to create cash flow. And those kinds of problems show up when you do this cash on cash return. You've had to invest a lot of your money in order to try to make a property cash flow for you. And long term, that isn't really the great strategy of working with your money. The idea here, unless you're going for that free and clear plan, the idea here is that you want that money you're borrowing to give you more money back. That's arbitrage. You're paying, 3.5%, 4% for the money, and you're getting an 8.5% or more return back. That's arbitrage. You're making more money, plus of course appreciation. Okay, so I kind of jumped the gun on that one already, where I talked about that secret of 10 loans. The idea of this is to make use of the cheapest and easiest financing you can get in the beginning. So my suggestion is that you make a mortgage broker your best friend, and find out what you can qualify for, how many of those federally backed loans that you can get, and then use those first to buy the properties you've got. After you've got those 10 loans used, and remember that your own house is going to count as one of those, but after you get those loans going, you've now started to build some momentum with your properties. You've got multiple cash flows coming to you, and you've got appreciation building, especially in times like we've got now. Boy, if you can get in the right markets now, you're going to see values really popping up for that, with that. And the sooner you can get into that, the better. Just how the cash on cash return works, just kind of a quick little number on that. Basically what you're looking at is your annual net cash flow. So how much do you receive? And that's after you've paid your property manager. And then from that, you might have some repairs that might be due, or it might be some other expenses, maybe vacancy. But what is your annual net cash flow? And then divide that by the amount of cash you've invested. So typically that's going to be that 20% down, and then you might have some extra closing costs, and maybe you had some repairs along the line, but what was your cash that you invested? That is then going to give you that number, that cash on cash return. I personally like doing this calculation every year. And in that particular case, I might not have bought a new property, but I want to know, if I were to sell it, how much is my equity that I've got sitting there? Because if I've got a property that's really gone up in value, and I know Matt's going to give me a bad time about this, but I have a property in Phoenix that I didn't sell, and I bought it really cheap. And so I've got a ton of equity sitting on that property. And, Phoenix is one of those markets that, boy, everybody wishes they bought in Phoenix, 10, 12 years ago. And now we've seen it go up in value. But honestly, I've got I'm making great cash flow on it, but my cash on cash return number isn't that good, because I could sell it and buy probably 2 houses for the equity that I have in that house right now. So those are just examples of ways for you to look at the properties you've got. And like I just said, I don't always follow my own rules, but that's, you get emotionally attached. Anyway. Okay, the idea with the 5 free and clear strategy is, and it's interesting because I run into clients that are maybe in their 40s or 50s, and the idea is, I would love to have 5 houses that pay me, $1,000 to $1,200 a month rent, and I don't owe any debt on that. So that means that you might be making $5,000 to $6,000 a month in passive income. When you think of it, that's a nice deal when you've got that, and realizing that over time the rent increases, inflation and everything pushes it up, and you don't have any debt. So for some people that are looking at retirement, that might be a really secure place to feel, because if nothing else, they've got these houses, they can get debt, they can go get a cash out refi loan on those, or they can sell them. They've got things that are more secure. So that becomes a strategy that they like to use. I have a book that's coming out called Less Tax for Mom and Pop Landlords, but don't worry, this is not fixing your toilet at 2 o'clock in the morning. What it is in this particular case, mom and pop landlords are called people, that's what the term is for people who have 10 or less properties, and they're typically single family up to 4 family homes. And that's a government term that they're using for this group of people because there's so many people that are now investing, and they realize all we need is 10 houses. But if you go for the 5 free and clear strategy, the idea is that over time, if you buy a house every couple 3 years, you've got appreciation going up, you get your 10 houses, and then as soon as you've got that, you can start selling off the ones you've had the longest or the most equity and paying off other houses. I'm going through this rather quickly. I mentioned the book Less Tax for Mom and Pop Landlords. I do go through that in much more detail with the formulas that you can use to put something like that in play. The way you start it, though, start with your mortgage broker, find out how much you can borrow, can you get those 10 loans, and then look for properties that are in good areas that you know you're going to get appreciation and that meanwhile have got great cash flow. And then the idea is that probably you're not going to hang on to all of these properties forever. You're looking for ones that are going to build up fast. And then when the market's hot in that area, you sell, take that cash out, and you're able to pay down other houses. I've had clients that have started this with the idea of ending up with 5 free and clear houses. But recently, with the property values that have gone up so much, they've ended up with about 7 or 8 houses that are free and clear. And they did that whole plan in less than 12 years. So, I mean, it might seem like, gee, that's a long-term one, but what else are you doing? You know, and it's the fact that you could in 12 years have 8 houses free and clear with just working your regular job, not having to do anything else other than just buying at the right time in the right place. That's the strategy that we're talking about here. In general, what are the tax strategies that we want to look at for these when you're holding properties? There's 3 types of expenses that we've got. First, there's direct expenses that we take as a tax deduction. Direct expense is something that's related to that property. That would be your mortgage interest, your property tax, if you've got HOA dues, insurance, any repairs that you've got, everything that's directly related to that. Always take all of the deduction for your direct expense. Even if that were to create a loss, it doesn't matter. Take all of that deduction in your tax return. Second are indirect expenses. These are expenses that have to do with you being in the business of having real estate. So, for example, you might have a home office, you've got a computer, you've got a cell phone, you've got certain tools that you use because you're a real estate investor. They aren't specific for any one property, but you have those tools because you have real estate. Those are called indirect expenses. Always take the deduction for all of those. Again, even if that creates a loss. There's a couple of ways to do that. You could, for some of my clients, they just set up like a little cost center, and then it just reports on their tax return, and it's for all of the general and administrative costs. Or some people want to just divide it and say they have 10 houses and they divide it by 10 and take the deduction for each of those. Whichever way you do it, just make sure you take that. And then the third one is to use the right amount of depreciation. This is the one, I call it a phantom expense, because depreciation doesn't really cost you any cash. And at the same time, it's the one thing that we can be flexible with. If you don't take a deduction for your direct expenses or your indirect expenses, you can lose them. The best you can do is do an amendment, but then you can only go back 3 years if you discover, oh, shoot, I should have deducted those things. It might be too late and you might lose them. Depreciation, though, you can stop, you can start, you can catch up, you can slow down. All of those have to do with what your tax situation is. If you're at a spot right now, for example, where you're showing a loss from your real estate, a tax loss, not a real loss, but a tax loss, and that loss is suspended, in other words, you can't take tax advantage of it, you might want to slow down and stop your depreciation because you can adjust it. If you're at a spot where suddenly you have a lot of income showing on your tax return for real estate, then maybe we want to catch it up or speed up your depreciation. We can do all of those things. And finally, you want to plan for capital gains. If you're going to be selling these, what are you going to do? Do you want to pay capital gains, or are you in a spot where you can kind of adjust your income? For example, if you're married filing jointly, you can have capital gains and other income of over $100,000 and pay 0 capital gains now. but you have to put the plan in place. And I'm not talking about having to do like-kind exchanges, which you can do as well, but you can plan for capital gains so you pay very little, maybe none. Maybe you do a like-kind exchange, which allows you to roll into another property, or maybe it's better just to pay zero capital gains and then go buy another property and start the depreciation clock all over again. These are all some of the things that you can do with tax strategies. Again, direct expenses, always take that deduction, deduct it all, even if it's a loss you can't currently take. Indirect, the same way, because it's use it or lose it. Depreciation and capital gains, plan for those, because you might have a few more tricks on that than you realize. Finally, the next one I want to talk about is, especially for people who are kind of new to the business of real estate investing and maybe didn't have their own business, is there are things that you're currently paying for right now from your personal expenses that quite possibly could be hidden business deductions. Those are those indirect expenses that I talked about. I've got a few pictures here of like your cell phone, your computer, education, meals out, auto, travel. You know, if you travel somewhere to go look at real estate, even if you don't end up buying when you're there, if you can show that you looked at real estate there, you have a deduction. Now, I want to just put a little note here, though. Sometimes people want to investigate a long time before they actually pull the trigger, and that can get you in trouble with real estate when it comes to taxes. Until you've actually made offers and bought something, you haven't really started your real estate investing adventure. You need to buy something, and then suddenly it's like, hey, I'm going to Florida, and while I'm there, I'm going to go look at some property. Can I take a write-off for the trip? Yeah, you can. And you know, if your spouse is involved in that as well, and your kids work for your real estate, this isn't going to work for your 2-year-old baby. But you know, if your teenager's coming along and you can talk your teenager into working, then you can probably take a write-off for their trip as well. So these are all ways that you can start getting those business deductions. The next group of some terms that I want to talk about is, and I know I talk fast, we're going through this fast. Make sure that if you make the notes of questions, and we will catch those up at the end. And we're leaving a little bit of time at the end for the questions. You're going to hear me talk about a couple of terms here. One is AGI, or your adjusted gross income. Now I'm going to be really a boring tax person for a second, but adjusted gross income refers to your total income. So this could be your W-2 wages and interest and dividends, the net amount of your rent, real estate income, capital gains, all of those things added, and then a few adjustments that we're able to take. You get a deduction if you've got self-employed medical insurance. There's a few things like that. But the AGI is an important number because we use it when we're determining how much of your real estate deductions you can take. You're going to hear me talk about AGI. Next time you have a look at a 1040, just look on the form to see where it says adjusted gross income and make a note of what your number is there, because you will use that later on when you're doing tax planning. Next term is leverage. I think if you buy real estate, you already know about leverage. What that is just using other people's money. Leverage is an amazing thing. It takes a good deal and makes it great. It takes a bad deal and sinks you if you're not careful. So the key here with leverage, especially if you're borrowing money to buy something, you want to make sure it's a good deal. And so that's where you need to go through the numbers. Is it going to give you the return that you need? And as I said, it can take a good deal and make it great. We love leverage in the right time. Critical mass is an interesting factor. What I refer to this with, I've seen a couple of clients do this, that they've got an idea of, I'm going to need to have 30 properties or 50 properties or some big number until I can retire. And these are typically high income people that are thinking, I'm going to make a couple $100s a month per house on my net income, or, whatever that number is. And so I'm going to need all these houses in order to make up my high salary. And instead, what they discover is there's a point that you reach that I call critical mass, where you have enough properties that you've purchased that you can then do cash out refi. That's a refinance of a property. And so you can pull some cash out tax-free, or you can sell those. But remember, we're going to do this so we don't end up having to pay a bunch of capital gains when you do it. But you can start getting new loans, and you can manipulate. I don't want to say manipulate like it's a bad thing, but what you're doing is strategizing with the properties you've got. I had one client who was a very high income earner for one of the big tech companies in California. And his idea was he was going to need to have 80 properties before he'd reach that critical mass. Interestingly enough, he reached it at 38. And he had a very high number of income that he wanted to hit. But what happened was he'd already bought enough properties that by the time we got appreciation working there, and remember, it's not just appreciation, but you have your tenants buying your equity for you. They're building equity. And the fact that he was able to do all of this and pay very little taxes, in fact, zero taxes, off of the real estate he got, meant it grew that much faster. So whatever your critical mass number is, what you think it might be, if you get going, you might be surprised at how quickly you hit that point. And by the way, he had to retire early because there was so much to manage just from the financial side of this. He wasn't the guy fixing toilets. He was the guy managing the loans and buying new properties and figuring out when it was maybe time to move out of a market and do an exchange into another, or manipulate, or I don't want to say manipulate. Again, it's not a bad thing. You're changing your numbers legally so he didn't have to pay any capital gains tax. That was taking all of his time. The next term that I want to talk about is real estate professional. This is one that we talk about frequently, and I think a lot of people have heard the term. When you are a real estate professional, in the eyes of the IRS, you're able to take real estate losses, paper losses, against your other income, no matter how much the losses are and no matter how much your other income is. Otherwise, remember that term AGI, adjusted gross income. If your AGI is less than $100,000, you can take $25,000 of real estate losses against other income. So if you've got a W-2 job, you can take $25,000, up to $25,000 of losses against your other income. If you make over $150,000 adjusted gross income, you can't take any of those losses against your income. Between $100,000 and $150,000, the amount you can deduct phases out. The exception to all of that is if you are a real estate professional, or if you're married filing jointly, if your spouse is a real estate professional. If you are, then you can take as much real estate loss as we can generate. And that's, by the way, when we put the pedal to the metal with that depreciation, because we want to we want to create paper losses. When it comes time to refinance property, your lender is going to add back in the depreciation. So it's not going to impact your ability to get a loan. All it does is impact the amount of taxes you pay. So if you can qualify as a real estate professional, or your spouse can, that's a big advantage. Talk about that in just a little bit longer. Cost segregation study is a specific study that you can do. You can hire somebody to do that. I have a home study course that walks you through how you can do it with templates, so you can do it yourself. What it does is takes your property and breaks it down into shorter lived assets. For example, let's say you buy a single family home and it's got an HVAC system, and it's got a garbage disposal, and it's got a washer dryer and a refrigerator, and it's got cabinets and floor coverings. All of those things are depreciated over shorter periods of time than your house. However, us CPAs often take it, nobody's done a cost segregation study. We end up putting the whole thing at 27.5 years if it's a residential, or 39 years if it's commercial. But if somebody goes through that cost segregation study, then we can pull out 5-year property, 7-year property, 15-year property, all these shorter lives. And what we're doing is we're front end loading that depreciation. Now, if 5 years into the purchase of this house, you say, you know what, now I'm going to push the button for that cost segregation study, I'm going to do it. That's when we get to do that catch-up depreciation. And it just hits you with a bunch of depreciation in that 1 year on your tax return. And that's often a year that we're doing when we really want to hit a big loss because you've had something else happen, like maybe capital gains. So this is how we are able to legally adjust how much taxes you pay. Cost segregation study is a big one that you want to be able to use. And then finally, just the calculation of how do you know what your gain or loss is on a sale. I do run into people frequently who tell me how much cash they made from a deal and think that I didn't make much cash, therefore I don't have to pay any taxes. Or I made a whole bunch of cash, that means I'm going to have to pay a bunch of taxes. But really, the amount of tax you pay is based on your sales price minus your cost of sales, minus your basis, plus your accumulated depreciation. That's how you calculate it. It might have nothing to do with how much cash you've got, but it's a very important calculation that we want to do before year end, so we've got time to do tax planning for that. Now I'm going to break these things down in a little bit more detail. I mentioned that critical mass. The idea is that you want to build your equity, your debt goes down, your appreciation goes up. Debt goes down because your tenant's helping you pay down that debt, and appreciation's raising that. So we've got two things happening, both of which are building your equity. That's why critical mass works, because other people are paying your bills for you, and appreciation is just the market working for you. Once you get in the game and you've got enough properties, over time you're going to see this critical mass just get closer and closer for you. I mentioned the numbers. This is just, kind of to go over this a little bit. If you have real estate law, if your adjusted gross income is over $150,000 and you have losses on your real estate, they become suspended losses, which means they just roll forward to a future date. You don't lose them, but they're just rolling forward unless you do something else. If you're a real estate professional, you are able to take those losses in the current year. The real estate professional, in order to qualify as a real estate professional, there's 3 tests for this. First of all, you have to have 750 hours in real estate activities during the year and more time in real estate activities than any other trade or business. So as an example, I had a client whose wife was really involved with their real estate. They were buying big apartment houses and doing reconstruction and renting them out and that type of thing. He wouldn't qualify because he was working way more than 40 hours a week. He'd have to work more in real estate than what he was already working in his medical practice. So we made her the real estate professional. She didn't have another trade or business. So she worked only in real estate. And so that qualified. She just needed 750 hours and then already was working more in that than anybody else. Number 2, you need to have material participation for that property. If you have a property manager, you need to have 500 hours of material participation. The third one is that each property has to stand alone. But you can file an election with your return that aggregates all of your properties. And this becomes another reason why it's so important to have more than just 1 or 2 properties, because if you've got 20 properties and you spend 25 hours a year on those, doing the material participation, which might mean reviewing the statements and talking to the property manager about your tenants and looking at what kind of maintenance you might need to do, maybe doing actual inspections on the properties. It's pretty easy to get that 500 hours. And if you've made that election to aggregate all of those together, you can hit that number. But that's what it takes to be a real estate professional. There are a few exceptions, just quickly, because these come up. If you are a limited partner in a limited partnership, like sometimes somebody might put a big deal together, you just put the money in, all you've done is just put money in and somebody's doing all the work. By definition, you cannot be a real estate professional for that property. Limited partners can't be real estate professional for that property. You still might be for everything else, but just not that property. And the second is if you have a timeshare. Again, just by definition, a timeshare doesn't qualify into this real estate professional status. It doesn't mean you're out for everything else. It's just for that property. Okay, cost segregation study. I don't jump the gun on explaining what that is. It's actually a study that you can hire somebody to do, or you can do yourself if you've got the templates, and you just go through and pull out the value of certain items. And following the chart, instead of being 27.5 years for this, it might just be 5 years. So when you're all done, you have these numbers, and then there's a special form that is filed with your tax return to say that this is what you're doing to accelerate the depreciation. This is one reason why you want to make sure that you have a real estate accountant working with you who understands this, because not everybody is used to using these kind of forms. But it's a great tool. I don't recommend everybody do it. You want to make sure you've got a strategy. The last thing you want to do is accelerate all your depreciation, and then you can't take that deduction because you're not a real estate professional and your income's over $150,000. Wait until you can take advantage of those kinds of strategies. This is the form you use, Form 3115, just as a note here. The template that I sell on my site, US Tax Aid, includes you're seeing the IRS instructions here. We've got like English instructions on how the Form 3115 is filled out and what you need to actually fill in for that catch-up depreciation, what you need to do when you're doing that. Basically, this is something that you would give to your tax accountant because, again, not everybody's used to using this form. In general, though, the strategy behind all of this is depreciation strategies are one of the few kinds of expenses that you can stop, start, slow down, speed up, catch up. You can do all of these things with that. You can't do that when you write off your computer. It's either you write off your computer or you don't. Depreciation is just like this magic deduction that real estate investors get to use. And that's one of the most powerful parts of the tax strategies that we use for real estate investors. Really quick, I talked about this formula, but this is something just to pay attention to, that when you're figuring out your gain, your sales price minus your cost of sales, minus your basis, add your accumulated depreciation, and then you get to take advantage of any suspended losses you've got. And that gives you your gain or loss. Basis is what you've paid for your property plus any improvements you've made. If you do a like-kind exchange where you sell a property and you buy another to replace it, you roll over your basis from your old property into the new one. So over time, if you do several of these 1031 exchanges or like-kind exchanges, your basis is going to continue to go down in value. That's why one of the things I like to look at is there a way that we can sell the property and not pay tax on the capital gains, so that when you buy another property, you get to reset the clock on the basis, so you get more depreciation. I actually talked about this. I think I ended up not following my notes at all and talking about a lot of stuff at the beginning. The buy 10 strategies is basically use your, get with your mortgage broker and then use those good loans, because good leverage is just a huge, powerful tool for real estate investors. In general, our idea is that we want to have our taxable income down when it comes to tax purposes, but at the same point, we want to have income higher so you can qualify for loans. The secret ingredient here is depreciation, because it's added back in. Taxable income will be down, you won't pay much tax, but your mortgage broker is going to add it back in for the loan qualifications. So we love depreciation when you're looking for that. Capital gains exclusion. This is a one, if you live in your house for 2 of the previous 5 years, then you can get a capital gains exclusion when you sell. That capital gains for a single person is $250,000. For married, family, jointly, it's $500,000. There's a couple of, and I think I've got this. Okay. You might want to think about, well, shall I move into my rental? If your property starts off as your principal residence and then you rent it out, you can do the 2 out of 5 years without an issue there. As long as you go forward, if you look back 5 years and you lived in it for 2 years, then you've got that capital gains exclusion still when you sell the property. If you rent it first and then you move into the property, I call it a problem here. It's just something else you need to consider. What happens is that you need to then allocate. A portion of that capital gains exclusion is not going to be available to you if you start off as a rental. That's a tax law that came into effect in 2009. And if you look on this online, you might still see people talking about saying that's no problem, but it is a problem. If it's a house first, then a rental, no problem. If it's a rental first and then a house, you will have some capital gains to pay. Better to know what it is before you go into it. And again, use one of those 0 capital gains strategies. Another way to get, in fact, I have a client going through this right now, is I mentioned that 2 out of 5 years. But what if you've only had your house for a year and some life event happens? What happens then? Can you get that gain exclusion? And the answer is yes. If you, in certain cases, you can get what we call unforeseen circumstances that get you the capital gains exclusion, or at least part of it, if you've been in it for less than 2 years. Some of the things that they have allowed is if you might have to go in a nursing home If there's, for some reason, you need to have separate residences, you've got a divorce going on, or something has happened there, you're separated. If you've gotten married, you need more space. A recent case was somebody who had a 2-bedroom house. They worked from home in one of the offices, had a baby. Now the baby needs that bedroom. And so they were able to get an unforeseen circumstances in that case because they needed a 3-bedroom home, or even having a tenant in the house. There could be different reasons why you might need to move. Right now, the IRS is being very lenient in this. Talk to your tax advisor if there's a reason why you might need to move out of your house and you've got a lot of gain. You might be surprised. You might qualify for one of these and still get your capital gains exclusion, even though it hasn't been that full 2 years. Let's talk for a minute about what if you're showing tax losses for your rental property. Always take your direct expenses, as I mentioned, always take your indirect expenses, but maybe it's time to slow down or actually stop your depreciation. In general, if those losses can't be deducted against your other income, because your AGI is too high right now and you're not a real estate professional, it's better to just wait, because your circumstances might change. And then we've got the ability, maybe you or your spouse becomes a real estate professional. If that happens, then we can really hit that. Using a cost segregation study, we can really hit depreciation. So that gives you the ability to be flexible. Just watch the AGI. If you do have suspended real estate losses, there's only a few ways that you can try to use those. One is to sell that property. If you sell the property that has a bunch of suspended losses, it goes into reducing the amount of tax you pay on your gain. Another is that you take your other properties that have got income in those, that real estate income, and you can use that loss to offset those income. So that's an advantage. Another is just reduce your depreciation so you don't make any more suspended losses, and do that same thing with your other properties. Reduce your depreciation so you actually create income that your loss can be used to that. And I guess this is actually the 5th of my 4 strategies. Another one is, if your adjusted gross income gets below $100,000, which it might do if you become a real estate professional and we get to hit the depreciation, then you can start eating away at that suspended loss up to $25,000 a year. So those are all strategies. Again, a suspended loss just sitting there is a missed opportunity. Take advantage of those suspended losses that you have, and that includes that real estate loss. What can you do to put more money in your pocket right now by reducing the amount of taxes you pay with that? Okay, one other thing to think about is sometimes I run into people that are wanting to buy their property. They want to buy property and flip it, or they just want to buy properties and sell them. And they don't want to have long-term holds. If that's the case, you're what's called a real estate dealer. Now, you can still have investment property, but for those properties that you're just buying to flip, you're a real estate dealer. And that means you don't have passive income. You have a business. It's not a bad thing, but you just need to make sure that you've got a different tax strategy for that, because a business is different than being a passive investor. One other thing to think about, we run into people that have got to use a rent-to-own program. This, by the way, can work well with properties that you've bought that are investments, and it's a way to sell those over time where you're holding the property. In that particular case, you still maintain that property as a rental. People pay with a lease option up front, and then maybe in 5 or 10 years, they have to exercise, or maybe you hold it out for longer and buy the property for you at an accelerated amount. During the time that they're in the property, they might be responsible for all the repairs, and so it's taken the burden off of you. You've got more cash flow because they're going to be paying for the right to buy this at a future time, and you still maintain all of the tax breaks. This can be a way for you, if you've got property that's really gone up in value, this can be a way for you to move it into a sales category without having to pay a bunch of taxes right now, because it's creating additional cash flow for the future, but it's not capital gains yet. And then I mentioned the idea about avoiding gain on sale. That's my big thing right now, is how can we sell these properties that have really gone up in value and hit that 0% capital gains rate? It might be easier than you think. Just make sure you know the numbers and talk to your tax accountant about ways you can really hit it to bring down your taxable income in the year when you do have capital gains. As I mentioned, for a married filing jointly couple, they can have over $100,000 in income this year and pay zero capital gains. That in some of the things that we look at, the offset that I mentioned, like-kind exchange, reduce your other income. You might want to consider, sometimes I have clients that are older that have got charitably minded, and so they end up donating a property. If you're going to do that, donate it before you sell it, so you get a huge charitable write-off. And some people want to gift it to their kids and start to deal with estate planning. Those are all strategies as you have got value in property as you're moving forward. In general, why sell at a loss? And I have to say, sometimes people have gotten in it's just something that's a downward spiral, and it's better just to walk away and take the hit. In most cases, though, it just is a matter of changing some of the perspectives that you've got with the property, maybe bringing in better management, hopefully. It's hard to say. I do have clients that buy in the wrong areas. They pay too much for the property, and it ends up being they can't rent it for even close to what the mortgage payment is. And you buy a couple, three of those houses, those kinds of properties, and pretty soon you're really underwater. And then if some life event happens, it might be time that you need to walk away from those. Those are also strategies that you need to plan for. Of course, it's better to just buy something that's got cash flow to begin with. Matt's nodding his head, but yeah, I'm sure you've run into people like that have gotten, unfortunately, they realized after about the third house that maybe this isn't working this way. So in general, if you've got losses, the first thing we look at, is there a way to deduct the loss? That probably is the best part of it. I want to just throw in a couple more ideas. I've got just a couple more slides here. Boy, we should have had like an 8-hour webinar on this one. Investing with pensions. Absolutely, you can do this. And I've had 2 different people ask me this week, do we need to cash in our pensions in order to use the money to invest in real estate? And please don't do that. Talk to somebody first, because if you do that, then you're going to pay tax on that money you've taken out. Whereas it's not that hard to use your pension to invest in property, particularly if it's passive investments like the kind you get with Matt's group. There are a couple of rules. You can't have disqualified people. In other words, you can't buy the house from yourself. You can't sell it to yourself. You can't move into the house yourself. But if you're buying legitimate investments, it might be easier than you think to use your pension. And that, just don't take the money as a distribution from your pension, because you're going to pay tax on that. Use it within the pension to buy the property. It's possible. You just need to talk to some people on how you set up that structure to do that, right? In general, in the investments that you're doing, and I know Matt is really good about that, talking about numbers over emotion. People who want to buy the house. I mean, I had a client once who said that she always bought houses that she wanted to live in. Well, the fact is that she lived in $1 million houses, and they typically make horrible rentals that you just can't get the return on. So instead of buying houses that you fall in love with the drapes on, or you just absolutely love that, or you'd want to live there someday, buy it based on the numbers. Because if the idea is that you want to have investments so that pay you passive income so you don't have to work all the rest of your life, then that's how you do that. Use a strategy first. Remember, leverage can be good or bad. Although we did talk about that free and clear strategy, because I have clients that are looking for that as a safety net for everything else they're doing. In general, though, leverage, when you're buying a good property and you've got a good loan on it, you're going to go faster building up your equity. Final comment I want to make is I see this in Facebook and other social media that people are looking for free advice. And my comment that I often say is free advice is often the most expensive advice you'll ever get. That's because you have no way of knowing if the person even knows what they're talking about. And sometimes I think people give wrong advice on purpose. I mean, it just drives me nuts. Whereas it can be so easy for finding people who really know what you're talking, they have the education, the experience, and most importantly, the point of view to help you get where you're trying to go. And with that, I like to say that I prepare, don't panic. I know that there's a lot of people talking what's happening with inflation. As real estate investors, I hate to say it, but we kind of like inflation. Inflation is our friend. Cash flow goes up, values go up. And if you're sitting in the right spot, that is a beautiful place to be. Make sure, though, that your strategies for investing, for taxes, for legal, all of that stay up to date, because the law does change, and you need to know that you're making the best decisions for what's right now. I used my example of my Phoenix property that Matt thinks I'm nuts to hang on to, but because I bought it when it was great, but I should have sold it already. But anyway, up to date strategies. Don't do what I do. Don't fall in love with properties. And finally, if you're interested in finding out more about what we do, I've got blogs, I've got books, home study courses. We do a group coaching session on Wednesdays that's very affordable. And you can find all of that at ustaxaid.com. And with that, Matt, I think we're ready for questions.
Awesome, Diane. Thank you so much for that. Yes, we're going to open it up for questions right now. How many people got some value and learned at least something new out of that webinar? Go ahead and type that into the chat box. I always learn something new every time I listen to one of your presentations, Diane. So I always appreciate you coming on. And we also like to leave this open for questions so that folks can ask follow-up questions, because some of those specific items you went through may be more applicable, or people want a little personalized expansion on that for their individual situation or something like that if they have a question. So just drop those into the chat box, and I'll read those out to Diane right now. Also, while we're waiting for those questions to come in, for folks that are new to Maverick, I know we have some of Diane's clients on the webinar tonight. It's their first Maverick event, and some other folks that were invited here. If you are interested in buying some of these cash flowing rental properties that are already fully renovated, have tenants in place on leases, and have property management in place so that you can own them in the most investor advantaged real estate markets without having to be there personally to manage them, we would love to do a consultation with you and get to know you, understand your investing goals, your buying criteria, and all that. It's completely free to work with Maverick Investor Group. The reason why is because we're a real estate brokerage, which means the way that we get paid is if and when you find a property that's the right fit for you and you close on that property, we get paid a broker referral fee by the seller. So the beautiful thing about real estate is that the buyer never has to pay anything with regard to commissions and referral fees. The seller pays all of it. And so we can work with all of our clients for free and not charge you anything, because the way that we get paid is on closed transactions by the seller, not by you. And so if you'd like to do a consultation with us, it's completely free. And we can talk to you about your investing goals and see if we can help you to identify some turnkey rental properties that would be the right fit for you this year. So if you'd like to do that, just go ahead and drop the word consult in the chat box, and we will reach out to you and make sure that we're able to schedule a consult with you, because we want to get to know all of our clients on a personal basis. And then, our entire business model is based on long-term relationships with folks. As I mentioned, we're helping people that were working with us 10 years ago continue to buy rental properties today. So it's a long-term wealth building process through real estate. So just drop the word consult in if you'd like us to reach out to you to schedule one of those. All right, Diane, the questions are starting to come in. I will read them out here. Victoria asks, if we make an election to aggregate the 750 hours for the real estate professional status, can we aggregate properties that are in different LLCs?
Okay, a great question on that. A couple things. One is that you aggregate for material participation, which I know I went through that really fast. But so that 750 hours, that's kind of a separate test altogether. That's where you're doing real estate activities. But the other is the 500 hours per property of material participation, unless you aggregate all of those. But in answer to your question, yes, they can be in different LLCs, as long as they're all properties that you're working on. So yeah, that can work. Yes.
All right. Next question, Diane, about cost segregation. Can you elaborate a little bit on the best approach for somebody that wants to do a cost segregation study on their rental property and front load the depreciation that can be accelerated, What is the best place to do that? Did you say there's something on your website that people can use, or how can just somebody go about doing that?
Okay, so there are companies that can do that for you. I think the ones I've seen usually start at about $2,500 in order to do that. You can get a cost. I have a home study course at ustaxaid.com that walks you through that. There's a couple of different templates that the IRS accepts for this. You have to first of all state what your experience is, and obviously if you're an engineer or you're in a contractor or something that works. But also if you're an experienced real estate investor. And if you've bought more than a few properties, you qualify for that. And you just have to show that there's basically a kind of, it's almost like a resume part that you fill out. And then you walk through and say, okay, we've got this, say we bought this property for $120,000. A portion of that is going to be the land. And so you look at what a bare land in that area would be, say 20,000. And the rest of it's 100,000. Now of that 100,000, how much can you attribute to floor coverings and to these various component parts? Maybe it ends up that the floor coverings, the carpets are absolutely awful and you're going to have to throw them all out. So you wouldn't attribute a lot of value to those. Those are the kinds of things you look at. And when you're done, we've got some clients that end up with 20% going to those things. Most people, it's closer to 40% or more end up in personal property items. And then there's a chart that you look at, and this tells you how much each of those would have for the amount of depreciation. At that point, it kind of becomes time for the accountant, unless you really like working with numbers, because we're going to look at how much each of those things were depreciated already, and then how much should have been based on how long their life is. If it's brand new, then, I mean, if you just bought this property, then it would figure out how much you start with that. Just as a note here, most of my clients end up doing a cost segregation study when they buy a property, and then we just kind of like have it on the shelf. If it ends up being, hey, I need some extra depreciation this year, when we're doing the tax preparation, we've got that already. We don't have to wait for the thing to be done. When you use it, you determine that at tax time when we do the calculations on all the numbers. But having all that work done in advantage is a real advantage. Most of my clients say they can do it once they're experienced with it in about a weekend per property. They can do their own cost segregation study. Probably the first time through it might take you a little longer, but it's templates that you need to use for that.
Awesome. Yeah, so that's great. So that's on your website at ustaxaid.com as part of a home study course. You've also got a lot of other home study courses there on different topics. So I would definitely encourage people to go check out what's available there. It looks like, Diane, some folks are already going to your website, and Peter is asking, will you be opening up more tax consultations because your website currently says out of stock?
Yeah, I know. I have a limit that I sell every month, and we sold out on the first day. I mean, it's kind of crazy. I almost feel sometimes like we're doing concert tickets. March 1st, and if you want to, you can reach out to my husband, Richard at ustaxaid.com, and he can tell you when we open it. But especially during tax season, I'm really, I really strict with that. Sometimes I'll open it up and I'll do some more consultations, but we're in tax season now, and I want to make sure that all the clients get all the time that they need for what we're doing already. But awesome. Yes, the first of the month, that's when they hit.
Awesome. Yeah, Peter, email Richard at ustaxaid.com. He's super responsive, and that's a really good way to kind of get in the front of the line there for information on upcoming
stuff. Somebody.
Yeah, exactly. You know somebody. So that's awesome. Diane, one more question. If with the pension plan approach, if you're buying a rental property inside your retirement plan, how would all of this depreciation work? Would it become irrelevant because you already have a retirement plan shelter for it, or how does that work?
Yeah, it does. It actually does become irrelevant. At some point, my guess is you might want to distribute out the property. First of all, I wouldn't take depreciation during the time you hold it. And then at some point you distribute it out. It's going to distribute out at fair market value. Typically people are doing this like when they retire, and so they want to distribute it, and they're doing it, gee, I don't have as much tax rate anymore, so they'll take it out of their pension at that point. And then that's when they do a cost segregation study and really hit the depreciation, because it offsets, or partially at least, offsets the amount of tax they have to pay on that distribution when they take it for the pension. So there's no, just wait. That's one of the, like I said, the beauty of depreciation. We can hold on it. and wait until it's actually in your personal name.
Awesome. All right. I think we'll wrap it up there because we're getting close to the top of the hour. The other thing, Diane, I want to just encourage people to do, in addition to going to your website, ustaxaid.com, and checking out all the free study courses and amazing free information you have on your blog there, is to go to Amazon.com and just type in Diane Kennedy and see all of your best-selling books there, because there's some incredible content there, either on Kindle or audiobook or hardcover, however people want to get it. Can you say again the name of your new book, though, so people can type that in and check it out?
Yeah, it's actually not out at this moment,
okay,
but it'll be less tax for mom and pop landlords. And if you come to US Tax Aid and go ahead and just register to get the free tax updates, I do those 3 times a week.
Okay.
You can quit anytime. I promise I'm not going to spam you. I'm not going to sell your name, but you'll then find out when I release that. And typically what I do when I release it, there's always like a special bonus for anybody on my list. So there'll be
awesome.
a little reason why you want to get involved in that.
Awesome. Fantastic. All right. So I want to thank everybody for coming out tonight. Diane, thank you so much for joining me tonight. This was awesome.
Thank you. And thank you guys for all coming out on a Thursday evening.
All right. Good night, everybody.